Hello, everyone. Thanks for joining. Whoever has joined, and there are people still joining, so thanks for that. I would like to thank for people who are going to watch this later. I know a few of them couldn't make it. I spoke to them earlier. Today we are going to talk about the market insights, how some of the regions in Australia has been performing, and regions which we believe could be the next spot for investments. Sorry, just give me. All right. So we will be looking at 500K to 700K market in some of the regions of Australia. Then we'll be looking into the trust accounts and how it can help you build your portfolio. We'll do Q&As at the end, and you can leave your questions in the chat as well. We'll be able to answer any questions you have at the end. All right. I have not introduced myself. I'm Hema. I'm the founder and director of Trillium Advocacy, and I've been working in the research field for quite some time. Data analysis is my key strength. Through data, I have developed a deep understanding of real estate market and what truly deserves successful investments. Since I have been working in the property research, it has given me invaluable insights into how markets move, where opportunities lie, and how to make informed decisions, confident decisions as well. So my passion in helping people build long-term wealth through smart residential property investments. Over the years, I have had the privilege to guide many of the clients and individuals and families in creating a portfolio that deliver both capital growth and passive income. So for me, it's about not just creating or buying a property, it's about empowering clients with knowledge and strategy and supporting them in the every step of the journey. All right. It's a lot about me, I know. I've got Paddy with me here. He is an accountant and a savvy investor who has helping a lot of clients. I'll let him introduce himself. Hi, Paddy. Thanks for joining. You're on mute.
Oh, can you hear me now?
Yeah.
Great. Thanks for inviting me, Hema. Hi, everyone. My name is Beeraka. I am a director of an accounting practice, and I've been running the practice for almost 15 years now. And we are property-focused accountants. So we've got a lot of investors, property developers in our client base, where we assist them with either purchasing property or developing their portfolio. Me personally, I've done about $25 million worth of property developments, and also built my personal portfolio worth over 6.7 mil, spanning both commercial and also residential assets. And we empower our clients to build wealth and also safeguard the assets using structures such as trust companies and SMSF. And also we've guided many investors and business owners through the complexities of the property ownership. Today we'll be talking about some of these things like structures to start with. Yeah, that's about me.
Thanks, Paddy. Appreciate it. All right, this is very important. The disclaimer, the full version is on the screen. This particular webinar is general in nature, and information provided is in this webinar doesn't constitute any financial, legal, taxation, or accounting advice. We have not considered any individual circumstances, and any information provided in this webinar should be independently verified with the professionals. All right. In the past webinar, we spoke about the strategies of investment and how to build passive income, and discussed about few case studies. Today we are going to look at 2025 market, where we are investing in early 2025. Where did we do it, and how is the market? In early 2025, we had identified few markets in Victoria and Queensland as well. We bought a lot of properties in metro areas of Melbourne and regional Victoria and regional Queensland as well. So today we are going to compare with the markets that we have invested in, and we are going to cover a few suburbs which has got the right potential in Victoria and Queensland. We'll also talk about what are the other markets that we are going to have out of Victoria and Queensland. Then I'll get Paddy to talk about trust structure and how it will help the investors. Few things going before going ahead. Please keep yourself muted. You can ask questions at the end. If there is a shortage of time, then please reach out to us. We'll be able to help unclear any of the doubts you have. All right. So we started investing in Melbourne very early in the cycle. Like many people ask me this, has it been growing? We are going to cover our experience buying in Queensland region, Melbourne, and regional Victoria from past 8 months. What was the purchase price in early 2025 and where it is currently sitting? Is it still a good market to buy? If yes, where will you be able to buy? For few suburbs that we invested in Queensland, like Kirwan, Rockhampton, Mackay, and in Melbourne, it was around the Craigieburn area, Sydenham, Point Cook, few in Bendigo suburbs as well, like Stratdale, White Hills, Kangaroo Flat. I can show you how it was performing from past 8 months. So you can see here the Melbourne, the graph what you're looking at has been showing the trend of the Melbourne property prices. You can see how it was sitting flat for some time, but it started to grow now. All the houses that you're seeing here has got a lot of developments in the near future, because most of the other states like WA or it could be SA, they have all overgrown, and we had only few other states that would perform very well, and one of them were Melbourne as well. And it is taking pride now because the prices have started to going to go up now. And in the North Melbourne, like Bendigo region, you can see in the past, say for example, 2022, where they were sitting, and now where exactly it's moving towards. So it's been very stable growth since 2024, and it is actually going higher. What we experienced from past 8 to 6 months is there is a shift in the market, and you can see how it's been growing. It was quite flat from the past and started to pick up last year. I can show you how Kirwan, Townsville, and Mackay regions have been performing as well. They were not flat. They started to grow early last year, but the prices have gone peak now. We have seen quite a bit of change in regional Queensland. For example, this is Mackay, and you can see the property prices going higher now. So can you see how it's been performing from past 1 year? That's like peak of the market now. I'll take you through the recent examples of the properties that we have bought in the recent, say, for example, 1 to 2 years. One is, I'll take you through the Kirwan example, so that would give you clear picture on how North Queensland has been performing. Sorry, it's Garden Grove. We bought this property in April 2025. We bought this for a client who wanted to build their portfolio, and we bought it for like 490. Sorry, it was not a 460K property price, and the income that we are getting is already 500 now. You can see the uplift that you have in the today's market. It's already 508, which is great because you already got a 60 to 70K, sorry, 50 to 60K market price grown in the value. The other one that I would like to take you through is Mount Lucia one. This is closer to the Kirwan as well. This was off-market property, and we purchased it for, I remember this, 500K, if I'm not wrong. Yeah, in October 2024, and the estimated price that you can look at it's 636. These clients, they came to us to purchase one property, and now they're purchasing the second one with the equity, extracting the equity on this purchase. So they have already got 100K on this property, and it's already positively geared because we bought it for 500, and the estimated income, it's actually giving us 600 now. Yeah, definitely it shows the income also as estimated because that's what's happening in that region. And these are the recent purchase properties, right? So you can see how the market has been performing in some of these areas. I can show you how the Bendigo is performing as well. Let's take it one of the purchases that we have made. This was off-market property. I know house doesn't look good that good, but it has got a 900 square meter block, which is great. It's a 3-bedroom, 2-bath, and 2-car garage. We bought this property for 574, and it's giving us $500 per week, which is good because the clients are high income earners, and he wanted to get some property which will, the focus was on capital growth, not on the renter yield. So we bought this property, which is going to give us enough, opportunity to subdivide it, or you can actually build another granny flat at the back to get more sort of income out of it. And the other property that this was a great property that I always think because I wanted to buy it myself. So this was also a property that came through in Bendigo, and it was 1 bed, 1 bath, 1-car garage kind of a property, 500 square meter block with good garden space in the back as well as in the front, and we bought it for 379K. Straight away it started to give us $400 per week, which was great. These clients are buying another property now because the property purchase price was very less. Initially we thought of buying 600K property, but we got this property because this was a very beautiful property and was yielding positive cash flow already. The other thing I wanted to tell you is the Bendigo property that I showed you earlier, the Putnam Ave one, it has got negative cash flow, right? This one has got positive cash flow. So you need to understand why I'm talking about this is because we need to understand where you're sitting at the moment. Have you got like any risk profiles? Have you got 2 people earning the income in your household? How much you're earning? What you want to do with your investment? All these things will come into play when we are trying to buy the properties. It's not just I want to buy a property and I'll be buying somewhere closer or whatever, because we have to understand your goals and we need to know that what you want to do out of your investments. This would help us provide you better services in terms of where you need to buy, what you need to buy, and what are you going to achieve out of these investments. We spoke about Bendigo, North Queensland, right? We have not spoken about the Metro Melbourne region. This was another property which was bought off market in Craigieburn. Why I'm talking about this property is we bought this for 520K. Hang on. Yes. And it was giving us 520 as a yield at that time. the clients were looking to buy a second property at that time, and you can see how much it has grown up from past 567. So we will be waiting for another 6 to 8 months for this to go up by 100K, and we should be able to invest in the other properties sooner rather than later. So what data is showing about the growth is actually happening on the ground. From past 1 month, I have been helping 3 clients, and couple are investing in Bendigo, and it was hard for us to find a property under 600K, right? I mean, the premium properties like 600 square meter blocks in good condition, because the prices have gone up quite a bit. And I have heard people saying that Bendigo is a regional area and the property prices won't grow. Before listening to any of these people, understand this. Did they do any sort of research? Do they know the market fundamentals? How they are saying this? Because when buying any investment property, as I told you, understanding the fundamentals, supply and demand, and how it's working, how it's going to work, the suburb itself, you need to understand all that before planning to invest, right? Because market cycle, the timing, the market cycle is very important. Days on market, clearance rate, what are the economic drivers? What kind of population lives in that suburb? And how the other markets have been performing around that particular suburb. Understanding these things are very, very important. I told you earlier, Victoria has been sitting flat and other markets have grown quite a bit. Um, Having said that, we have seen quite a bit of growth in North Queensland as well. This is another property that we bought recently, and it was, I guess it was 4 months ago, and the price we bought it for like 600K. Hang on, let me have a look. Sorry, 570K, and it's already giving us 665 as a income. This was just 4 months ago. I believe it's 660, not 665 per week. And you can see the property price, which has gone up in 30, 40K. So can you see the difference? When we evaluate these kind of properties, we look at the cash flow, and in early 2025, the cash flow was neutral for most of the Bendigo region, right? Now it has started to become positive. So when you're looking at investing in any property, you need to consider your goal of the investment. As I told you earlier, what is the time horizon? That means how long you're going to hold this property for and how fast you want to extract the equity. These are the drivers for you. Say, for example, if you want to extract equity in 1 year, in 1 year and want to buy another property, then Victorian market is not suitable for you. You probably look at WA or Queensland market. So it's essential to get professional advice, providing your financial situation, goal of the investment, and what you want to achieve out of it. Like whether it's going to be a passive income strategy or it has to be a cash flow strategy. Looking at your existing income and what is that you want to achieve, that would become a fundamental criteria for us. And remember, you can't buy because your friend has bought the property in a particular suburb. You need to factor in a lot of costs that are associated with buying that property. Factor in insurance costs, property management, council rates. When you consider the expenses and the money that's coming into you, you'll understand whether it's worth buying that property or not. Also understanding bad pockets and good pockets are very essential, because while buying any property, if say for example, if the vacancy rate is around 4%, does that look good? If you're buying in a bad pocket, I'll tell you, a lot of vacancies you have to consider. And if it is a flood zone or bushfire, the insurance costs will be so high. So even if you have done research on the suburb, it's very essential to understand the landscape of that suburb. Um, for example, if you're buying in Victoria, do consider some cons like, I don't know, I have gone towards this. Some cons like stamp duty cost, increased land tax. It does impact the investors, but overall, it has got a great potential. You have to consider the market cycles, the cycle that actually goes from 5 to 6 years. So investing in a cooler market would give you the fuller cycle of growth again, depending on your goals. If you ask me still whether I'm going to buy in some of the Bendigo region, I would say yes, because depend on the client brief again. Now let's look at the suburbs that has come up in our research. So let me go through the list of suburbs. So this is how we get the list of data, right? We have around 251 suburbs, and we will shortlist the suburbs going through a lot of other factors, which will take, I'll be able to take you through in a moment. But what our job is, we get the raw data. We'll be able to look at each and every individual information that it has been giving, and based on that, we'll be able to prioritize, okay, whether it fits the client's brief or not. And we use various tools to identify suburbs like high growth corridors. I've been using DSR data from past couple of years, and we use SQM Research, Price Finder, Archistar, and new tools like Stash and Hashtag. These are like pro users, right? And understanding those data becomes very complex for normal people. We always triangulate the data because you can't rely on only one data source. From our recent searches, we have got the list of suburbs. What you're seeing here is what we have got, which has met our client's brief. Remember, the criteria we have taken is a very generic one. So that's the reason you're seeing 251 suburbs here. We need to dig deeper to understand the circumstances. It'll all depend on how many properties you currently own, how many you have sold, what is your goal, and what is that you want to achieve out of your investment, and what is the risk factor. These are the greater opportunities across Australia. I've seen many people buying in the same state, buying in the next road where they have got their primary place of residence. You're basically risking your profile. If the market goes down, it's going to be a problem. You shouldn't be discounting 15,000 suburbs at all when you are investing. All right. So from the research, I'll take you through a couple of suburbs because it would be a good understanding to see how it's been performing. Let's take Mount Gambier. We have been investing in Mount Gambier. Let's say my system has become slow. Mount Gambier. Let's say houses. All right. So demand to supply ratio for Mount Gambier, it's sitting around 61, which is great for us. There is a lot of opportunity. So if you look at how it's been performing, it's been stable in terms of the demand and supply ratio. If you look at the typical price, hang on. Typical price is sitting at 569. When we started to invest in Mount Gambier is basically this year, in the starting of the year. And you should be able to see how the prices have gone up. So in 2025, from April, May onwards, it started to go up. So these are the fundamental metric that we consider while investing. You're seeing this. I'll show you the suburb which we have invested, and this is not the right time to invest in. Let's say Craigieburn. Oh, did I go wrong? just copied. In Craigieburn, we had invested earlier last year, and now we are not investing because I'll show you how it's been performing. All right, I got it wrong. Anyway, so let's just look at where exactly the demand to supply ratio is sitting. Can you see that? Mount Gambier had the demand and supply ratio of 61, whereas this one is sitting at 55. So it's getting into that sort of a hot market. And how the history has been, it's been stable. In terms of the typical value, I'll take you through the history. When we started to invest, we were investing in that sort of last year, like end of last year. So you can see how the prices have gone up. Can you see this? It's now it's not the right time to invest in Craigieburn because it has already turned into a hotter market. And if you're looking at properties like 600K, you won't be able to find anything. It's very hard to find anything that you can invest in. So you have to understand all these metrics and understand the market cycle. And you need to know when you need to enter the market, right? Either it has to be bottom of the market or it has to be a bit more warmer to enter the market. So you will be able to get good value for money and you will be getting good income as well. So analyzing the market sentiments to understand the cycle. Generally, the market cycles run in, like, as I told you, 5 to 6 years. Sometimes it can be 3 to 5 years as well, depending on warmer market or cooler market, or if it is a hot market, then the cycle will be lesser. The other thing that needs to be considered is what are the factors that are influencing the market, like the economy of that region. Some suburbs rely on only on one economy. That could be mining. So they are more volatile in terms of like the market cycle itself. There will be a lot of boom and bust, as you know. So to play it safe, you need to see the suburbs which are on the diverse economy, like agriculture, tourism, healthcare. All that matters a lot. The next thing that we consider is the infrastructure developments. When there will be a lot of infrastructure developments happening, there will be a lot of jobs created, and that would attract more workers and their families, and that would increase the housing demand faster than the new supply coming into the market, right? You can see, for example, I'll take you through the Bendigo one. The Bendigo population forecast and how much the infrastructure developments happening. There are a lot of sites that would provide this information. You need to evaluate those. There has been quite a bit of infrastructure developments happening in Bendigo, like rail network. There has been airport access. They have revitalized the whole entire CBD as well. So it has attracted a lot of commuters, investors as well, and expanding the buyer pool and raising the property competition. So when we shortlist, these are the factors that we consider, and depending on your circumstances, we can go over 3% vacancy. We can look at socio-economic profiles as well. It has to be very high socio-economic profile. Low socio-economic profiles wouldn't give you much, rental income in those areas. So let's look at another region, which our research has shown greater opportunities in. That's the Melton region. Ballarat and Melton have picked up pretty quickly, although the yields aren't matching yet. That means if we are buying a 600K property, the yield or the rental income would be around 480 to 500 max. We need to be very careful while buying in Ballarat. Few properties are negatively geared, as I suggested. Few are neutrally geared. We have bought properties in Ballarat, but I would suggest doing a deep dive into buying in Ballarat. If you're looking at 422s. That means 4-bedroom, 2-bath, and 2-car garage. You can consider Merton because it'll take you through. I'll be able to take you through a few things. Like Merton has got the population growth forecast of like almost 50% for 2040, right? The government is expecting to see huge population growth, and the infrastructure developments are happening quite sporadically. New Melton Hospital project, probably I'll be able to take this through. Let me open this one. Sorry, just give me a moment. So this one, you can search for the New Melton Hospital, to be honest, because it has already been in the one sec. New Melton Hospital project summary. They have been doing pretty good in terms of the development, and I have seen a lot of information popping up in their council websites, because they have started working on this project, and I guess $900 million has been spent on this to construct the New Melton Hospital in Cobblebank. Together with new TAFE and secondary schools, this hospital is going to be a main center, metropolitan activity center. So it's going to be a bigger gateway for healthcare and education and training, and that would create a lot of jobs as well. All right, so going back to our insights, let me take you through. So we have got Queensland, we have got Townsville, Rockhampton, Gladstone, and Cairns and Mackay region as well, which has come up in our research. And New South Wales, we have got Tamworth, Albury, Griffith as the growth areas. In Victoria, we have got Ballarat, Melton, and Bendigo. Bendigo, we have been investing in from past 8 months, and Ballarat we have invested. Again, as I told you, the strategy is going to be different for Ballarat. SA Mount Gambier, I've already shown you the information. Port Lincoln and Vyala has been come up in our research. Tasmania, Devonport. I have never invested in Devonport earlier, but it has come up, and yeah, it is showing great growth in those areas. All right, so this is what I wanted to share. If you have got any questions, please do leave them in the chat, and we should be able to answer. And I am going to take through the property, trust structure. Paddy, would you be able to talk through that?
Yeah, sure. So we'll talk about the trust and what are the benefits of buying the property in a trust. The most important reason why we suggest trust as a structure to hold the wealth is mainly to get ability to actually borrow more money and grow your portfolio. So when you buy a property in the trust, there's a limitation in terms of how much you could borrow. However, when you buy a property in trust, at some point in time, the property starts to become a positive cash flow property where it can pay its own debts. And as an accountant, we can issue a letter stating that the property in the trust, the loan in the trust is being paid by the trust itself. And the guarantees that you may have placed initially when you bought the trust will be in a way released to create more borrowing capacity. So that's the primary reason. Other than that, there's also some other benefits, such as land tax. When you hold a property in your names, or within the trust, the value is in the land. When land goes up in value, there's a higher tax that needs to be paid. When you hold all the property in your personal name, the threshold where the tax has to be paid would be at a highest marginal rate. So in order to avoid paying highest land tax, we use trust to actually have segregate them into multiple trusts or entities, where each trust may have a threshold before your land tax would start. So depending on a state, the land tax would change. So for example, in Queensland, the threshold is $350,000, which means if your the value of the land as calculated by the council is less than $350,000, you don't have to pay any tax. But as the property goes up in value, land is the thing that goes up in value. At some point in time, the property, like the council, will start sending you the land tax bills. So in order to reduce the tax, we use trust. And we talked about the borrowing power. When we set up a trust with a company as a trustee, the company will be the holding property on behalf of the trust, and you and the people will be beneficiaries, where the trustee will be holding on behalf of the beneficiaries. So when a loan is applied in the name of the trust, the corporate trustee or a company will be the one where which is being used to borrow the money, and individuals would only guarantee that they would be servicing the loan. So as I was discussing, once the trust becomes once the trust can pay its own loans, we should be in a position to borrow more money. That's when you should be in a position to multiply or grow your portfolio. The third benefit is asset protection. This might be applicable to both people and also business owners. Especially with the business owners, there's a lot of risk with the business. And if a business fails, there's a possibility that the creditors will run after any assets that a business owner may have, whether it's in the business or outside the business. This is when it is important to have a good structure in place where the property or assets can be held in the trust, where the creditors cannot see what assets are being held, and they cannot reach and access the assets. So there's like literally a big wall where people cannot know what assets are the business owner is owning. This basically shields all the wealth from creditors. So it's ideal for business owners. However, some of the individuals may also be able to use the asset protection, especially doctors and lawyers, and sometimes accountants, like whoever's got high risk industries where there's a potential for a legal suit. That's where the trust could be really of a good help. And the other benefit is creating a legacy. When with the property, as we know, we want to create a portfolio and pass it on to our next generation. When the time comes, as part of transferring the wealth over to the next generation, if the property is held in the personal names, you potentially may have to sell the property and then give the money to the next generation, or you may transfer the property to your offsprings or children. So when this happens, in both cases, when you sell the property, you'd have to pay the real estate commissions and legal fees and also taxes. Also, with transferring the property, you still have to pay stamp duty to transfer a property from your name to your children's name. However, with the trust, we can avoid all these taxes, real estate commissions, or legal fees. With the trust, what we do is we simply change the name of directors of the company and also the shareholders of company to your children, and then suddenly the property is being controlled by your children. So it's a very simple aspect where an accountant can actually assist you with changing the directors, and then suddenly you can transfer the wealth to the next generation. So that's a lot of saving, because we have seen from so many of our clients when they are looking to transfer their property, they have to go through a lot of this hell in a way, trying to transfer the properties and costing a lot of money and in terms of tax and fees. So these are the main benefits in buying a property in the trust. But the major one, as I said, is the ability to borrow unlimited money is the primary reason why we're recommending trust. But again, this is not a specific advice. It may change depending on your personal circumstances. Is there another slide, Emma? I wanted to also talk about negative gearing, because this thing comes up every now and then. As people got used to understanding that using rental property, you can actually save some tax, like the tax man is able to pay you back some of your tax by using the negative gearing. However, when you're doing that in the trust, the negative gearing or negative cash flow are actually sitting in the trust, and you can't claim it personally because the property is owned by the trust, and if there's any profit or losses, that has to be dealt within the trust. So what happens to the losses? Can we claim? How can we claim it? So basically, all the losses will be accumulated in the trust up until the point where the trust starts to make some positive income. And when trust starts to make some positive rental income, we can then use those losses and apply against these profits. So there's a lot of runway before the trust will start to have a positive income. And when all the losses have been exhausted and when there's a positive income, that's when the income can be distributed to the beneficiaries. Now, with the trust, it's a discretionary, we actually set up a discretionary trust, and there's three different types of trust to start with: a discretionary trust, a fixed or unit trust, and an SMSF-based trust. So we might set up trust depending on our personal circumstances, but majority of them we set up are either SMSF-based trust or the discretionary trust. Because it's mainly within the family. And with the discretionary trust, as the word discretion says, the trustee has the ability to distribute the income or capital within their own discretion. Meaning, you can, within the family, whoever is earning lower income, the trustee has the ability to stream all that income to a lower income holder. In that way, we are in a position to save tax by giving income to the low income earner within a family. So that's another advantage of trust, where you don't have fixed entitlement, and the trustee has the ability to distribute the income according to their discretion. So that's the frequently asked question about negative gearing. So key takeaways and next steps. Basically, the buying property in trust offers flexibility, protection, and legacy. And creating trust for, so basically another point to mention, when we set up trust structures, we don't buy multiple properties in same trust, mainly being there's issues with land tax or issues with borrowing. So each property is actually held in a separate trust. So that way we're not cross-collateralizing, especially with banks. And with the legacy, as we said, mentioned, the transition of control is very simple by changing the director and shareholders. That will allow you to simply transfer the wealth from yourself to your children.
Paddy,
Yes.
one question that the other attendee was asking. So when you actually set up a different trust, like individual trust for individual properties, will you be able to do cross collateralization and extract the equity from them, or you can't do it?
We normally say not to cross collateralize at all, but of course you
Mm.
could still do it. That shouldn't be a problem. The main reason is you could always draw the equity out of the trust. So that's how we are able to not cross collateralize. But
Okay. You're just extracting that,
you can cross
sorry,
collateralize.
equity, and then you're investing in it, extracting equity individually, and then you're investing in the other property, right? Yeah.
That's correct. Yes.
Okay. You were saying something. Sorry, I interrupted.
Now, to answer your question, yes, you can cross collateralize, between the trusts.
Yeah. Yeah. Sorry, go ahead.
Um, yeah, I think that's to cover some basic stuff about the trust. I think there is a question in the chat about what
Yeah.
are the basic requirements to build a trust, and also any specific requirements to be part of the trust. Um, Thanks for the question. So anyone can open up a trust. It's a very, very simple process. They have to be over 18. They have to be in Australia uh, to be a resident trust. And the requirements for trust is because we actually suggest to have a corporate trustee, the directors need to be having their director ID, and we should be able to open up the company to start with as a trustee, and then after that we set up a trust. So I hope that answers the question.
Yeah. Thanks for that. The other thing that I wanted to ask you is, when you set up a trust, for example, you're setting up a trust for an individual state, right? You can't set up a trust for all states. Unless you're choosing to buy in an individual state, you should be able to hold on to it. Once you decide to do it, that's when Paddy can set up the trust based on where you have chosen. Because individual states have got different rules and regulations, if I'm not wrong.
Yeah, that's correct. Each state has got its own regulations. Some states have, you need to stamp the trust, but some state doesn't have to. The naming convention, some states say you have to include the whole trustee with corporate trustee's name. Some don't have to. So there are different regulations, but that shouldn't affect the purchaser. It's just for compliance side of it.
Perspective. Yeah, got it. Paddy, one more thing, just asking on behalf of the people watching this video. Say for example, if someone wants to buy 600K property and they have exhausted the borrowing capacity already, would you suggest to get the trust done to increase the borrowing capacity, or is that an option?
This is more of a question for a mortgage broker, but I have been a mortgage broker in the past, so I might just use that hat for now. So when you're buying a property in the trust, the serviceability is the main thing for to get a loan. And initially, when you're trying to buy a property in the trust, banks would look at your personal serviceability, and based on that, you would be able to get a loan, and then you're basically guaranteeing that loan. So some people may have maxed out on borrowing. That's when you may have to look at the whole structure and see how we can restructure so they can borrow more. But to answer your question, if somebody's already maxed out, and just because they are setting up a trust, they may not be able to get a loan. But there's an exception to that. The exception is that if the rental income from the property is able to repay the loan, then you'll be in a position to get a loan. So that's the only exception. This is mostly true in the commercial properties where the rental returns are high, and you don't leverage it 80%, but you probably leverage it like 60 or 50%, and the loan is quite less, so the rental income should be able to recover for the repayments.
Yeah. And many people ask this question to me, like when I'm having conversations with the clients, they will be like, if I'm buying, what is the difference between buying under my name and buying under the trust? As you have already suggested, you would definitely save taxes. How much you would be saving if you're buying under the trust as opposed to buying under the name?
A lot of people think, how much am I saving? But it's not about saving that we are focusing on, right? We are trying to build a property portfolio. And if we start to build property portfolio under our own name, at some point in time, we get restriction from the bank. Bank would say, yeah, we have given enough. You don't have ability to borrow anymore. That's the main reason we are using trust as a vehicle to buy a property, and keep repeating, borrowing more. But to answer your question, they may not be able to save as much, because when you buy a property in your own name, the land tax thresholds are higher. So you don't have to pay any land tax up until $600,000 worth of land. And within the trust, the threshold is only $350,000. However, when you look at math in terms of how much you save by buying a property in the trust versus personal name, you will be paying a little bit higher, land tax if you are holding a property in the trust. But the point is, you lose out
Sorry.
on the growing the property portfolio.
Yeah. When you're selling the property, because when you build this portfolio, you will be eventually looking at earning a passive income, and you're looking at selling half of your portfolio to clear off all your debt and then start earning the passive income. If you have accumulated properties on your name and you're selling at the time of the retirement or even before, what would be the taxes that you pay? And under the trust, what are the taxes that you'll be paying?
Sure. When you sell an asset in your personal name, you can have a capital gains discount, which is 50%, and then you pay the tax in your own personal marginal tax rate. Since each person's situation is different, depending on what other income they may have for that particular financial year, the tax rate may change. But the highest they would pay probably is like 49.5%, including Medicare and Medicare levy surcharge. When you sell an asset in the trust, trust is not paying any tax. It is the beneficiaries are the people who are going to pay tax. So with the trust, when a property is sold and when a profit is made, that income, that capital distribution is made to beneficiaries, and beneficiaries will then have to pay tax in their own right. However, they still be able to get the capital gains discount. So there's an advantage by using the trust, where you can have a discretion to distribute the income among the lowest income payers within the family, and then you still retain the capital gain discount benefit.
Got it. Yeah, it's very important to understand your individual circumstances, like what is your earning, what are the tax rates, so depending on that, each professional will be able to help you. Any questions do you guys have? Anything regarding the trust structure or anything about the properties, please do contact us so we can provide better information when we assess individually. Anything else you want to cover, Paddy?
Yeah, unless there are any questions from the viewers.
No? Cool. All right. Thanks for joining, everyone. Appreciate taking some time to go through all this. It's very helpful for us as well if you provide your feedback. And thank you. Thanks, Paddy.
Thank you, Hema.